The wealthy and the financially savvy don't pay taxes the way you do. Warren Buffett pays a lower tax rate than his secretary.
The Sonic is making waves because she makes less money than her billionaire boss, but pays a higher tax rate than he does.
And real estate investors like Donald Trump pay nearly $0 in taxes.
They showed he didn't pay any federal income tax. So
that makes me smart.
But here's the part that most people don't understand. It's 100% legal, and you could do it too. Sure, maybe you don't have $1 billion or even $1 million, but you don't need that. As a licensed attorney, who's not your attorney, who spent a lot of time studying the tax law, what I can tell you is that there are ways that regular people can use to pay less money, if not $0 in taxes legally. And that's what I want to help show you how to do in this video. And of course, before you actually make any tax changes, talk to a licensed tax advisor in your area. Don't just blindly listen to a random guy on YouTube. Here's the part that they don't tell you. You are taxed based off of two things. Number one, you're taxed based off of the category of your income. And number two, you're taxed based off of your taxable income. Not the actual income that you generate, but what's taxable out of that income. So if you want to reduce your taxes, there's two things they can do. Number one, change the category of your income. And number two, figure out how you can reduce the taxable part of your income. Not your actual income, but the taxable income. There are three categories of income: earned income, portfolio income, and passive income. Earned income is the money you make from your job. Portfolio income is the money you make from your investments. Passive income is the money you make from something like your real estate rental income or your royalties from a book that you created. And the reason why there are three different categories of income is because the tax rates that you're going to pay are going to vary depending on how you earn that income. So let me show you how this works, and I'll show you some things that you might be able to do as well. When you go and work a job and you make, let's call it $50,000 a year, again, this is earned income, which means number one, you are going to pay the highest tax rates because that's what the tax code says. And number two, when it comes to lowering your taxable income, you have very few options. So let's take a look at what your taxes are actually going to look like. These are the marginal tax rates, and what I say is that you're going to pay 10% in tax for every dollar that you earn from $0 to $12,000. Then you're going to pay 12% in tax for every dollar that you earn from $12,000 to $50,000, 22% between $50,000 and $105,000, 24% between $105,000 and $201,000, 32% for $201,000 to $256,000, 35% for $256,000 to $640,000, and then you're going to pay 37% in tax for every dollar that you earn above $640,000. So because these are marginal tax rates, what that means is if you make $50,000 a year, you're going to pay 10% of that money in taxes up to the first $12,000, and then you're going to pay 12% in taxes for every dollar that you earn between $12,000 to $50,000. So the top tax rate here is 12%, which means the effective income tax that you're going to pay on your $50,000 is $5,751. And then on top of that, you also have to pay your FICA taxes. This is your Social Security and Medicare taxes, which is 7.65% of your salary. That's $3,825 in FICA taxes, which effectively means that you're going to pay $9,500 in federal and FICA taxes, leaving you with $40,500, and I'm assuming no state tax, no local tax. But now let's kick it up a notch. Let's assume now that your category of income changed from earned income to portfolio income, and now you made $50,000 from your stock market investments. You bought a stock years ago and you sold it for a profit and you made $50,000. How do your tax rates change even though you made the same amount of money? Well, when you make your money from your investments, these are not the tax brackets that you follow. These are the tax brackets that you follow, and I'm assuming that you are a single tax filer for all of these examples, and I have rounded all these numbers just to make it simpler. So you're going to pay $0 in taxes for every dollar that you earn between $0 to $47,000. Then you're going to pay 15% of your income in taxes for every dollar that you earn between $47,000 to $519,000. And then you're going to pay 20% in taxes for every dollar that you earn above $519,000, which means yes, the top tax rate here is 20%, the top tax rate here is 37%, and yes, you have a 0% tax bracket here, versus here, if you make $47,000, your top tax rate is 12%. So you made the same amount of money, but now you're going to pay $450 in taxes as opposed to $5,751 in taxes. And then when it comes to FICA taxes, when you make your money from your investments, your FICA taxes are zero. Zero Social Security, zero Medicare taxes, which means your total tax is $450, which means you're going to be left with $49,550. It's not how much money you make that matters, it's how much money you get to keep. But let's kick this up a notch a little bit more before I show you some of the things that you can do. Remember, there are three different categories of income. You have earned income, which is the money you make from your job. You have portfolio income, which is the money you make from your investments, like if you sell an investment. And then you have passive income, which is things like you earn money from your real estate rental properties or you earn money from royalties. So let's assume now that you have a portfolio of rental properties and you make $50,000 in a year as a profit. This is how much money is left in your bank account at the end of the year. How much money are you going to pay taxes on that $50,000? So we know the category now is passive income, and your passive income is taxed at the same rates that you are here with your earned income. So it's those higher marginal tax brackets, but the difference between this passive income and this earned income is you have the ability to lower your taxable income here that you don't have the ability to do here. Because remember what I said in the beginning of this video, there are two things that are going to determine your taxes. Number one is the category of income, right? Earned income, portfolio income, passive income. And number two is your taxable income. You made $50,000, you can't really lower that taxable income here. Here, you made $50,000, it's the same tax rates as here, but you have the ability to lower your taxable income here when you invest in real estate. I'll show you exactly how real estate investors do this in just a minute, but for the sake of this example, what you're gonna have the ability to do is essentially say, hey IRS, I made $50,000 of income, but I only have $10,000 of taxable income. Maybe even $0 of taxable income. Again, I'll show you how to do it in just a second, but for the purposes of this example, let's say you tell the IRS you only have $10,000 of taxable income. Remember, you have $50,000 in the bank, but now you get to tell the IRS that you only have $10,000 of taxable income, which means you're going to pay the same tax rates as here, but you're only going to pay taxes on $10,000. Well, if you have $10,000 of taxable income, you're only in the lowest tax bracket of 10%, which means you're going to pay $1,000 in taxes, and then you have to think about FICA taxes, right? Well, as a real estate investor, you have, I'm going to put that right here, $0 of FICA taxes. $0 of Social Security, $0 of Medicare taxes, which means your total tax bill is $1,000. You made $50,000. This is what's in the bank. And now you are left with $49,000. It's not how much money you make that matters, it's how much money you get to keep. So now that I've laid the foundation of how this works, let's talk about how you can actually do this and how you can potentially use some of these tax strategies to lower your taxable income, even if you're making your money through your job. So let's break this down. And I should also remind you that for those of you that are investors or want to become investors, I put together a brand new free investing masterclass where I walk you through how you can get started as an investor and find hidden investment opportunities before everybody else. I'll also share the exact framework that my firm and I use to research investments and find opportunities before they hit the headlines. It's a free masterclass. There's a ton of value in there. And when you register for the masterclass, you're also going to get access to Market Briefs, which is my newsletter for investors, for free. So if you want to get the Investing Masterclass and Market Briefs all for free, all you have to do is register, and I have the link for you down in the description below. So let's put this in action. The simplest way to invest your money is to invest your money into the stock market. How can that help you with your taxes? Well, we talked about how your portfolio tax rates, if you invest your money in the stock market, look like this. But they only look like this if you understand the difference between this: long-term capital gains, short-term capital gains. And what that means is, in the eyes of the IRS, when you invest your money, now that income that you're earning is called CG, capital gains. But not all investments are traded equally. If you invest your money in the stock market today and then you sell your investment for a big profit in 2 months, you're not going to qualify for these short-term rates. What the IRS is saying is that we want to encourage you to be a long-term investor. And by long-term, they mean at least 1 year, and ideally a year and a day, at the very least. If you invest your money for at least a year and a day, you are now investing for long-term capital gains, which means you qualify for the lower tax rates. If you are trading stocks, you're buying a stock and you're selling it in 6 months, 9 months, even 11 months, that's considered short-term capital gains. And in the IRS's eyes, you are no longer an investor. You just have a job in the stock market, and you are going to pay the earned income tax rates, which are the higher tax rates that you pay when you earn your money from a job. So you do not get to qualify for these tax rates when you follow the short-term capital gain strategy, which is buying a stock and holding it for less than a year. If you own a stock for more than a year and you make a profit, you get to qualify for these long-term capital gains rates. And this is where things also get a little interesting, because if you make some money from the stock market, you have to pay taxes. But if you lose money in the stock market, you have the ability to lower your taxable income if you have a job or if you run a business as well. So let's assume now that you buy a stock, you put $10,000 in there. It doesn't matter if it's $10,000 or $1. It's just an example. You buy the stock for $10,000 and then a few years go by and your investment drops in value to $8,000. So you lose $2,000 of value. Now you only make money or lose money if you sell, but in this instance, let's assume that you actually sell the stock 2 years later. So now we're talking about long-term capital gains. You sell the stock 2 years later and you lose that $2,000. Well, according to the IRS, you can take some of this loss, some of this $2,000 loss, and use it to lower your taxable income. So if you make $50,000 a year, you will have the ability to reduce your taxable income by some of this, which is kind of nice because if you take this $2,000 and you blow it and lose it on something stupid like a vacation or a car or whatever you lose it on, you don't get to deduct that from your income. Here, because you lost that money in your investment, you do get to reduce your taxable income some. But now let's take it one step further. Real estate has some of the most powerful tax deductions and write-offs that our tax code has to offer. And these are things that really anybody can use, assuming that you are investing in real estate. I'm not talking about buying a house to live in, but renting properties out to other people. And yes, this could be you going out and buying a property and renting it out, or it could also be you going out and buying a duplex or triplex or 4-unit property to live in yourself that you also rent out to other people. There's a lot of ways to hack real estate, even if you don't have a ton of money to start investing in real estate. I have videos on my channel where I go over that. I'm not going to highlight that in this video, but let's assume you go and buy this single family house for $250,000, which yes, these types of properties do exist if you look maybe outside of where you're living. You buy this property for $250,000, and let's assume that the value of this land is $50,000 and the value of the actual property is $200,000. So $250,000 for the land and the building, and then you rent this property out for $2,500 a month or $30,000 a year of rental income. Pretty nice. But all this income is not yours. You have to pay for your expenses. You have to pay for your property taxes, your insurance, your maintenance costs. You have to pay for the manager to run the property. So let's assume after paying all of your expenses, just to keep the numbers round, that you are left with $15,000 of profit at the end of the year. Now remember what I told you in the beginning of this video. When you invest your money in real estate, this is considered passive income, which means your tax rates here are going to be the higher earned income tax rates. But you have the ability to lower your taxable income. So you made $15,000 of profit, and by profit, I'm going to talk about this is the cash that you have in your bank. But because this is passive income from your real estate, you have the ability to lower your taxable income, which is how much money you tell the IRS that you're going to pay taxes on. Let me show you. When you invest in real estate to rent out to other people, you get to qualify for what's called depreciation deduction. And what depreciation is, you get to tell the IRS, hey, my property is 1 year older, and so it has wear and tear. And because this property is 1 year older, I deserve a write-off. Even though I have money in the bank, even though that property might become more valuable, I still deserve a write-off because this property is 1 year older. That's what depreciation says. And then the IRS says, sure, you get to qualify for depreciation, and the base depreciation that you get to qualify for, if it is a single family property like this, is 127.5 of the value of the property. Remember, the value of the property is $200,000, the value of the land is $50,000. This is the basic that you get to qualify for. I'll show you what that actually means. And just for those of you that are a little bit more financially nerdy, if it is a commercial property, you qualify for 139th. But because it's a single family property, what that means is you take $200,000, the value of the property, divide that by 27.5. That's how much of a deduction that you get for the next 27 years. That means you made $15,000. That's what's in the bank. And then you could tell the IRS, I deserve a $7,200 depreciation write-off. It's a paper write-off because it's not actually money leaving. It's just on paper, which means your taxable income here is $7,800. You're only going to pay taxes on $7,800, even though you have $15,000 in the bank. And again, the tax rate that you're going to pay is that higher earned income tax rates. But this is just the beginning. If you have a more savvy accountant, a more savvy financial accounting team, now you can even reduce this further. Take a look. So same example as before, $250,000 property, rent it out for $2,500 a month, $30,000 a year of income, minus $15,000 in expenses, you have $15,000 of profit. That's how much money is in your bank account. Well, what some accounting teams can do is they can do what's called accelerated depreciation. So we know that the IRS gives you this 127.5 depreciation. It's called straight line depreciation when you invest in a single family property. But if you have a savvy accountant, what they can tell the IRS is, hey, some of the wear and tear on certain parts of this property are going to accelerate, meaning you're going to have more depreciation in the early years. So in that first year of us buying this property, we should qualify for a 20% depreciation on the value of the property. So the value of the property is, again, $200,000. The land is $50,000. You do not get to depreciate the value of the land. So $200,000 property, 10% of that is $20,000. So now you have $15,000 of profit and you take a $20,000 write-off. This is depreciation. And now you have a $5,000 loss. Again, it's not an actual loss. You have $15,000 in the bank, but now your taxable income is negative $5,000. What that means in practicality is you're going to pay $0 in taxes even though you made $15,000 in profits. And then what you get to do is you have a couple options. Number one is you can take this $5,000 loss and carry it forward to next year's profits that you make from this property. Or let's say you work a job. You're making that $50,000 a year job. Well, according to the IRS, if you have a loss on your passive income, you cannot use this to offset this unless you fit into one of the exemptions. And the exemption number one is if you make under $100,000 a year, well, then you can take up to a $25,000 loss against your income. So here you made $15,000 of profit. That's how much is in your bank account. You take a $20,000 write-off, again, just on paper, so you have a $5,000 loss, which means now you get to reduce your job income because you're making under $100,000 a year to now $45,000 a year. That's what you're going to pay taxes on. You made 50 grand, you're going to pay taxes on $45,000, and then you made an additional $15,000 here that you're going to pay $0 in taxes on. Now, this is where I'm going to take a quick pause and tell you a little personal story, because the first time I started learning about this, I was very angry because I did not grow up learning about money. I did not grow up learning about investing. I did not grow up learning about financial education, and I had no idea that this world existed. But this is the game that financially savvy people are playing, is they start to learn how taxes work, because it's not just how much money you make, it's how much money you keep. And once I started to learn this, I wanted to understand the game, because the reality is that money is a game and most of us never learn the rules. That's why I started making these videos, is to teach the things that I wish somebody would have taught me years ago, because unfortunately we all work to get paid, but we never learn how to actually use that money as a tool. So my goal for you is to learn this, and yeah, maybe get a little bit upset, but now I want you to understand the game. That way you can use it to your advantage, because once you learn it, then you can use it. If you never learn it, you're never going to understand how some people are able to make huge sums of money and pay less in taxes. It is a game, it is a rule book. I want you to learn how to use it, and well, we can kick it up another notch from here too. Same situation, you bought this property for $250,000 and now you're renting it out, you're making money and you're paying less money in taxes because of this depreciation deduction. And now let's assume that you bought this property in a great area and now it is worth $500,000, and now you go to sell this property for a big profit. You made $250,000 of profit. You've been making rental income all these years and paying less money in taxes. Well, now that you've sold this property, you have to pay taxes, right? And we've already looked at the capital gains taxes, that 0%, the 15%, the 20%, and you made $250,000. That's a big profit, a big gain, except you don't have to pay it with real estate, because in real estate, you can qualify for something called the 1031 like-kind exchange, which says if you take this property and sell it for a profit, in this case $500,000, you can take all this new money, all this $500,000, go out and buy another property. It can be bigger, nicer, more rental income, and now you can pay $0 in taxes on that appreciation, on that gain. And now that you bought a new property for $500,000, you can generate more rental income and have bigger depreciation, because the value of the property is probably more as well. And you can do that again and again and again and never have to pay a penny in taxes as you flip these properties into more valuable properties. And you can do this until you die and never have to pay a penny in this capital gains tax. This is a game that wealthy people play to compound their wealth tax-free. They buy properties, they generate rental income, pay less money in taxes legally, then they work to see the value of the property appreciate, then they sell the property for a big profit, and then use that profit to buy another bigger property. That way you don't have to pay any taxes, which then creates that opportunity to generate more rental income. And you can do that again and again and again, assuming you hold each property for longer than a year and a day. But let's kick it up one more notch, and let's talk about now you starting a business. And if you don't have a business right now, don't worry, I'm gonna show you some things that you could potentially do that might not be as heavy of a lift that you might imagine. So whether you are a 1099 contractor or you started a business, these are things that you may wanna consider. So hypothetically, let's assume that your business makes $100,000 a year and you have $50,000 of expenses, so you have $50,000 of profit, and now you have to pay taxes on this $50,000 of profit. And I'm going to assume that we're not talking about your salary here. This is just the business's profit. Well, when you make your money as a business, this is that earned income tax rates, the higher tax rates, but there are things that you can do to lower your taxable income if you spend your money strategically. For example, in a business, you were allowed to spend money on things that are ordinary and necessary for your business. So if you need a cell phone to run your business, that could be a write-off for your business. You buy that phone, you get a tax deduction. You need a laptop for your business, you can buy the laptop, get a deduction for that business. If you need to go on a trip to Hawaii to look at rental properties, to meet a business partner and need to stay at a nice hotel, well, that flight, that hotel is now a tax deduction. And if you need to go with your business partner who happens to be your wife or your husband, and now you get to stay at a nice hotel and you have to do some things in Hawaii because you're there for a business trip, well, those things can then become a tax deduction, assuming it's ordinary and necessary for your business if you can document that you went to Hawaii and did business there. And then we have a newly modified Section 179 rule, which says that because of Section 179, if you buy heavy machinery for your business, you can take up to a 100% write-off on that machinery in year one. Now, if you are, let's just say, a podcaster, a TikToker, you have a food blog, you might not need a big piece of machinery, but maybe, and this is just an example that I had my accountant give me, maybe because you have the social media presence, you have to look like a big baller. So you gotta get a G-Wagon, because every big baller on the internet has a G-Wagon. Now, I don't recommend you do this because I think it's a stupid financial decision to buy a G-Wagon to lower your taxes, but let me show you what some people are doing and how the tax code can work. A G-Wagon weighs over 6,000 pounds, so it gets to qualify for this heavy machinery deduction. And this G-Wagon, let's say, I'm gonna draw it right here. It's gonna be a pretty ugly drawing, but let's say this G-Wagon costs $100,000. And then you take $20,000 from here and you put it down. So you use $20,000 as a down payment. And let's assume for the purposes of this example that you use this G-Wagon 60% for business, 40% for personal use. So if it's 60% for business, that means you take 60% of the value of this G-Wagon, which is $100,000, and now you can take the $60,000 and use it as a tax write-off. Remember, you only put $20,000 down. And I don't recommend you should finance vehicles at all. I think you should buy cars in cash because they're depreciating liabilities, but I'm not talking about the financial education side. I'm teaching you about the tax side of things right now. You put $20,000 down, you still have 30 grand in the bank, and now you get to take the $60,000 deduction, which means you are gonna have a negative tax. Because why? Because, well, you had $50,000 of profit, you take the $60,000 deduction, you have minus $10,000 loss. And now if you work a job, or your spouse works a job, you can take this $10,000 loss and you can reduce that job income because you have a loss in the business. Now remember, in this case, you still have $30,000 in the bank because you made $50,000 of profit, you put $20,000 down, you have 30 grand in the bank, but because you get to take the 60% write-off on the value of the G-Wagon, that's why you now have a negative $10,000 loss on your taxes, which you can use to offset your gains, which means if you start a side hustle for your business idea, and that side hustle has an actual business plan that you can document, and you spend money on that side hustle, maybe you have a cooking blog that you start, maybe you start a podcast, maybe you start whatever it is that you're interested in, and you spend money in it, and you're generating some revenue, but you're losing money, well, that loss that you have for your business investment can be used to potentially lower your income that you make from your job, which means yes, you can make the money from a job and use some of this loss to offset some of that income. And in certain instances, depending on what it is that you're purchasing, it could be a paper loss, not an actual loss on your bank account. This is why it's so important to understand how the tax code works. As you start to earn more money, as you start to invest your money, I highly recommend you go out and start investing a little bit of money to find yourself a good accountant or a good tax advisor, because they can help you lower your taxable income. And I get it. I mean, nobody likes paying for accountants and that type of stuff, but it will be a few $100s well spent. And then as you start to earn more, it might be a few $1,000s. And as you earn more, it might even be more than that, just depending on how you're earning your money. But I'll tell you from my experience, a cheap accountant can be very cheap. I used to have a very cheap accountant, and they were a cheap fee, but they ended up costing me a lot of money in late fines, fees, and overpayment in taxes. And then when you find a good tax advisor, and listen, I am a licensed attorney. I don't do my taxes myself. I find a specialist who this is what they do. Find somebody who can help you with tax strategy. I'm telling you from my own experience, because there's a very big difference between just filing your taxes and doing tax strategy with you, because tax strategy is meeting with you every month or maybe every quarter and going over what does your taxable income look like and what are things that you can do to lower your taxable income based off of changes that are happening in the tax system. So as you start to earn more, get yourself a good tax advisor, a tax strategist. And again, for those of you that want to become investors or are investors, I have a free investing masterclass for you down in the description. And finally, if you got value out of this video, the best thank you is a referral. So if you could, please share this video with a friend, family member, colleague, or fellow investor to help spread this type of financial education that we should have learned back when we were in school. Russia accused the United States of trying to devalue its $37 trillion of national debt without informing the American people. How? By using stable coins, crypto, and gold. So if you hold dollars or stable coins or have a retirement fund, you want to pay attention. Why does Russia care that the United States government has $37 trillion worth of national debt?